Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market short. Before we get started, everyone take a look at the disclaimer that's appearing in front of everyone. Just be aware that Market Chameleon is not a registered investment advisor or broker-dealer. If you have questions, certainly go to them for any questions relative to your positions. We are strictly presenting information for informational purposes only. With that, Dima, are you ready to get going?
Yep. Good morning, everyone. I'm going to share my screen and let me see. 1 second here. And as a note, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it. He'll read it back to me. And to give you guys a couple minutes to type those questions in, we're going to start out taking a look at our pre-market report, see if we could get insights, what's going on in the pre-market hours, and then we're going to move on to the questions. So pre-market report, up top here, we see a calendar view, which does allow you to go back in time if you wish to see pre-market activity at a particular historical date. We show the last week's worth of data. So this way you could eyeball if anything unusual pops up or if you see some kind of pattern or trend. Today, we are on February 27th. And so far, we see 670 stocks are trading higher in the pre-market, 279 stocks trading lower. As far as volume goes, we have 199 million shares trading on up volume, 52 million shares trading on down volume. If we convert that volume to dollar value, we have $4.1 billion worth of stock trading higher, $1.7 billion worth of stock trading lower. So from that perspective, so far, the trading in the pre-market looks like it is trading with a bullish lean. Let's look at it from a couple more perspectives, then we'll move on to the questions. I'm going to scroll down, and now we have a list of stock symbols that are trading at pre-market hours, along with the price changes in pre-market, volume, alerts. We have a most active list, the biggest percentage gainers in the pre-market, and the biggest percentage decliners. Here I have 132 stocks that made our percentage gainers list, 42 on our largest decliners. So this also points to a more positive or bullish lean in pre-market trading. Now, to make this list, we do set thresholds for volume, price change, liquidity in a pre-market, because things in a pre-market tend to trade with less volume, less liquidity. So as you could see, any security, if it's listed on a major U.S. exchange and meets those thresholds, it can make this list. And that includes small cap stocks. It includes ETFs. It could be a leverage product. It could be an inverse ETF. Could be preferred stock. So to narrow this list down further, we could use the filters above. If you created a watch list and you follow a group of stocks, you can filter this list using that watch list, your watch list with this filter. That tracks your own watch list that you saved. We're going to use this filter in ETF in our example. I'm going to click on it, and we have a drop-down menu with different ETFs to select from. We're going to click on SPY. And when we do that, the list below will get filtered by stocks that are holdings in the SPY ETF. So these here are S&P 500 constituents, and there are 13 stocks that made our biggest percentage gainers list, 4 in our largest decliners. So that also indicates that trading in a pre-market has a bullish or positive lean so far. And we looked at it from a couple different perspectives. So we gave it a couple minutes now. I'm going to take questions if you have them.
Yeah, Rick is back and he's asking question. Sometimes when I open the calculate in options multi-leg strategy, I get a squiggly line when I put a date in the drop down. Can you say why?
Yeah. So let me navigate. I'll go to SPY as my default.
I think Rick actually had a question yesterday too, Rick. I don't know if you want to you had a question yesterday, Rick. I still have the chat up. It says, can you review the compare payout on date in the option calculate review? If you want to, Dimitri and I were looking at it and we didn't know exactly what you were referring to. I don't know if you want to add to that question from yesterday too. I'll put that in the chat.
Yeah, so I think this question is similar from the way I'm understanding it. So let's go to the options chain here. And let me go out to a month that's and thank you for the question, by the way. It makes it easier, to know what you are looking at and interested in. But let's go to the options chain in SPY. Okay, so we're on SPY. We have this options chain. I went out to March 8th expiration. This has 9 trading days to go, 11 calendar days. And when we set up, we could set up a multi-leg strategy here to analyze. Okay, so let's just do a call spread, right? So multi-leg means that there's more than one leg to the strategy. So call spread will look something, you're buying one call, selling another. So let's do the 500, 505 call spread, right? So I'm going to click on the 500 call. So I clicked on the bid. And now you see it pop up buying the 500 call for 860. We've got some more data here. And then let's go to the 505 call. And I'm going to click on the bid here, which will pop up a sell ticket, right? So this is the multi-leg trade. So far, we got buying the March 8th 500 call, 860, selling the March 8th 505 call, 504. We could change the prices here, but that's not important for this question. And what we're going to do first is just calculate to run this payout diagram. And by the way, I'm thinking about changing the view of this, making it a little bit more modern looking. So I'm going to slide, after we calculate, we get this output down here. Okay. Now, a couple things with this. So first we see the graph, right? And that stands out because this shows us what the strategy looks like at expiration, right? So at expiration, the option, each leg, these are different stock prices at expiration. So if you pay $3.56 for the strategy, right, that's what it's set up to. Of course, you could change the prices, but let's leave it at that. Well, if the stock goes above 505 over here, you see that both calls are in the money, and this spread is worth $5. So it's a $144 profit, right? If the stock drops below 500 at expiration, you could see here, well, both calls are going to be worthless. So you lose that $3.56 you paid for the strategy. And then here, of course, in between, depending where it lands, it could be a different value. So this is at expiration. Well, what if you don't intend to hold it all the way to expiration? Right? Because we said, well, there's 9 trading days to go, 11 calendar days. But let's say you want to hold this strategy till, a day before expiration. Maybe you're looking at some kind of an event, or maybe you're looking at this strategy because you think it's a good value and you want to hold it for whatever, a couple days, but not all the way to expiration. And you want to see a potential profit and loss diagram. Well, before options expire, they're going to have some time value, right? So the problem is, how do we draw that profit loss diagram? It's not the same as expiration, where you pick a stop price, right? Once you pick a stop price, you know that at that point, either the option is in the money or out of the money, and you know by how much. So the payout diagram is much easier to draw when there's, an exact value we could calculate. At expiration, we could calculate an exact value for the option. But prior to expiration, we can't calculate the exact value of an option, even if we pick a stop price, because that option has time premium, and the value of that option will depend on what the implied volatility of the option will be, right? Which we don't know, right? Because if we knew that, we'd, be gazillionaires, but we don't know what the implied volatility of the option will be. We don't know even where the stock will be, or the implied volatility will be some date in the future. So somehow, though, we could start changing some of the parameters and trying to make guesses. So first, what we could do is draw a payout diagram based on today's implied volatility. So let's just assume they're unchanged. But if they're unchanged, right, the implied volatility, I'm saying if it's unchanged, this payout diagram will still look different, because there'll still be decay, and based on where the stock price is, it'll have different values. So the first thing we'll do is pick a date, and let's say we want to hold it till March 1st, right? So that's before expiration. These options will expire March 8th. What does this strategy look like on March 1st, given all these different potential stock prices? So we'll go in here and let's pick March 1st. So when we do that, you get this little line over here, the dotted line. So the dotted line is comparing your potential profit and loss to on March 1st to all the way out to, expiration. So this assumes that we did not change the implied vols at all, right? So the implied vols, today's implied vols, 11.4, 10.7, right? I didn't change them. We left it alone. And that's what we're plugging into the Black-Scholes model at every stock price. See where this dotted line is for what we expect on March 1st. Because obviously on March 1st, there's less days to go to expiration. And now we're seeing this blue line. So what is the blue line represent? Well, if the stock falls, right, we could see here that on March 1st, the expected, if it falls to this price, 499.15, you see I'm hovering over it, and you see while I'm hovering over it, I get a pop-up window showing us the data points. And what is it saying? That, well, first on March 8th, which would be expiration, your projected loss is $356, right? Because it's below 500, right? So both of these will expire worthless, and you lost that $3.56 you paid for the strategy. However, on March 1st, there'll still be time premium. It still has a chance to go back in the money, go back up. So it's not going to be, this spread is not zero, right? So it's calculating the value of the spread, and it's saying, look, the stock price, if it falls from now to, we're at 505 and change, it goes to 499.15 on March 1st, and the implied volatilities are the same. The end of day March 1st, you would lose $158.61. Okay, so not the full 356, but it's a loss, right? So that would be your project. That's why that blue line isn't all the way down to that red line, right? It's showing you the difference between March 1st and March 8th. Now to the upside, right? Even to the upside, let's say it does go in the money. And now let's say the stock is 507. Well, at expiration, both those options are in the money. And they're gonna offset each other, and it's gonna be worth $5, right? You end up buying the stock at 500 because you bought the 500 call, and you sell the stock at 505 because you sold the 505 call. That's $5. You paid 356. You made the 144, the difference. But prior to expiration, you still have time to go, so they have premium. So it's not quite the full amount because it still has a chance to go below, right? On March 1st, you still have time to expiration. They both have premium. Both options don't go to parity. It's too close to the money. So at that point, it's projected to make $37 at the end of day March 1st. So you're comparing March 1st versus March 8th expiration here. So that's what this line here, the overlapping line, is giving you a visual estimate comparison of what the strategy looks like, prior to expiration, given the date that you pick versus expiration. But what if we think that the implied volatility will increase or decrease, right? So now we could change assumptions. That's what the calculator lets us do. It lets us to make new assumptions. So if we change the assumptions here, okay, we could go up to this implied vol, and let's say we think that the implied volatility right now is higher, and by March 1st, this implied volatility will come down. So let's say over here, we're right now March 8th, right? So March 8th, we could see here that the implied volatility slopes in, right? So you could see here March 8th, the implied vol is 10.5. And as we get closer and closer to expiration, the implied vol comes in. So let's just assume that, March 1st, we're looking at that trend and saying that trend will continue. And we think that implied volatility will come in as we get closer to the March 8th expiration. So let's take out one implied vol click out of here. So I'm going to use this IV and I'm going to drop it by one click. So I want to take this down one volatility click and this down one volatility. Okay, so I'm going to do both of them by using this arrow. Okay, that's what I just did. I use this arrow, or down one click, and I'm going to recalculate that. So now these are my assumptions, and now I still have to pick March 1st, but it's using the new implied vols. And now it looks like this, right? So it changed a little bit. And what it did was I mean, it's a subtle change, right? It's not a huge change. Um, I know what the change, is, because as you're reducing the implied volatility, you're getting closer to parity, right? Like if you reduce volatility to zero, it's basically like the options are in parity. So this to the upside probably improved a little bit. To this downside, it got a little bit worse. But this would be your new line, potential line, looking at different stock prices on March 1st versus the expiration. Again, given that assumption that the implied volatilities will be at those levels. Okay. So this is a what that blue squiggly line, I guess, means.
All right.
Yeah.
Rick was then asked, once you load an option, can you save it to see it later? Save it's the question to see it later.
Yeah.
Or
So
you have to reload it each time.
well, like for example, if you load this strategy and you want to add it to your watch list, you can press this add to watch list. And if you do that, you click on it. I don't want to click on it because it'll just add it to my, but basically here, you click on it and this strategy has been saved to your watch list. Okay. So when you go to your watch list with your options, right, it should be in there. So this way, let's see. Let's just do it. I guess since you asked the question, I'll share. Let's see how that looks. So now I'm on my watch list and I'm going to pull down. So you got to go under options, strategy watch list. Okay. So keep in mind, you have to do under the options list. And here's this new SPY that I just added. Long 500 strike, short 505 strike for 350, date added February 27th. So I just added it now. And I didn't change the prices, so it just kept the price here at 356. And then you could watch it from here and later in the day, or where you want to go, click on it and I guess you could, hold on a second. And if you click on it, it'll take you back to the options chain where you could analyze it again. Okay. So you see from my watch list, I clicked on it and there it goes. It brings it back up. It'll bring it back up with the most current prices. Okay. So if you analyze it and you're like, this is a great strategy to watch how it pans out, what happens to it. And you don't want to forget about it. You want to watch it, tomorrow, the next day. That's added to that watch list. And then you could monitor it from your watch list. Remember, your watch list has stock components, and then go to the bottom. It has your option components.
Now, when the options expire, does it automatically
It
remove?
won't. So no, see, I have some, I think, expired options here. So once it expires, you just want to probably just get rid of it. It'll save like the end, the end value if you go back to it. Like here, I added this December 20th, 23rd, right? So it was $15.05. It went out worthless. But then you could to remove it, you have this X. So just click on that and then remove it. Remove that so it's not cluttered. And then you'll have, and then you narrow down your watch list to the ones you're watching.
All right, we got about 4 minutes left. We have a new user asked a question, and obviously any trading questions are really up to each individual because there's unlimited number of answers. But his question is, how long in advance should you be closing a bull spread on the day of expiration? If you put a market order and the person likes using a market order to close out. And for any reason, if you don't, and then the question goes on, and for any reason, if you can't close a position, what will happen?
I mean, yeah, and look, some of these fall outside the scope of the analysis in our analytics. You're asking about trading questions, and really, you probably should talk to your broker about this. These are like, trade.
Yeah, because your execution platform each is different, right?
It's different, and
even if you put it in a market order, you may not get filled.
Well, you should get filled, but usually, you got to be careful with market orders, especially in the liquid options. And, you should talk to your broker probably about this. But these are like trade execute. It falls outside the scope of researching, trades. And I don't know what the scenario is with you, but of course, if you don't, a lot of it depends when you're doing spreads. Like here's a spread. We'll just go over some of the risks. Okay. In general, I'm just going to go over this spread since we had it up. So look, if this call spread, if it's below 500, both options will expire worthless. There's nothing you could do, right? In this situation, right? So stock is $492. The 500 call, 505 call, it's worthless. That's it. Now let's say the stock is well above, like 515. Well, both calls are in the money. So what will happen is, they both automatically get assigned, right? Exercised and assigned. And what will happen is it will look like you bought the stock for 500 and immediately sold it for 505, right? Because those are the options. You bought 500, sold 505 simultaneously. Difference is $5. And so it's like making a $5 profit, but of course you paid $3.56 for it. So the profit is the difference in 144. The risks to the spread are when they're close to the strike prices. If it closes somewhere in between, what if it closes right in between? Well, you have the 500 call gets automatically assigned, but not the 505. So what happens is you bought the stock for $500, right? Once that is signed, you have the 500 strike, 500 call. You bought it, but you didn't sell it out because this isn't going to get assigned on you. So now you're just long stock. And you also have some risk if it's pinned right at the money. Because if you're short a strike, let's say it's at 505, exactly 505. Well, there's you might not get assigned on the 500. So you might still come in long 500, long the stock at 500. So there's risks involved with these spreads. It's important to understand all those risks before you get into it. It's probably a good idea then to talk to your broker about it, about all the risks, involved. And they might have different rules around, closeouts and assignments, so it's important to talk to your broker about this type of stuff.
All right, perfect. Right with that, we're right up against the hour. Actually, we're a minute into the opening bell. Great job, D, as always, my friend.
Thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.